Welcome to Investor's Guide, a show that helps you find the perfect investment product in the market by looking at all of your needs. Now, we've been promising you this show for weeks, a special on insurance where we'll have experts from the industry come in and answer the questions you have. And I'm doing this because of the number of questions we receive about insurance policies week on week. Now, remember, at the bottom of your screen is my email ID. Write to me if you have any question at all about your insurance policy. We'll bring the concerned company into the studio and we'll ask them your questions. You can also reach us on our Facebook page where you'll find a copy of this show. The video will be uploaded. And of course, you can reach me personally on Twitter. Let's get straight to it. On the show this week in the studio, Sandeep Batra, Executive Director of ICICI Prudential Life, and Sandeep Ghosh, the CEO of Bharti AXA Life Insurance. Sandeep and Sandeep, thank you so much for coming in.
Hello.
Of course, we had to bring this up. We had to have both of you come in. And there are some questions that are specific to the companies that you all represent. We have questions about the industry in general. I want to start by asking you this. Every week, my inbox is full of questions from unhappy customers who write in saying that I'm holding an insurance policy. It's lower than the value that I actually invested. I feel cheated. What do I do now? And there are examples right now on the show that we're going to bring up as well. But I want you to answer this. Of course, we know that the regulations have changed now and products are better. But for those of us who bought before the change, what do we do now?
I think it's important to get why we bought an insurance product in the first place. And when you talk of an insurance product, you're talking of returns alone. I think insurance products, by definition, are long-term investment, come protection. So they are guaranteed to complete the savings target that you had set for yourself, irrespective of what happens to you. I think we have to keep that in mind. And when you're talking of the returns are lower than the amount invested, the question I think maybe the insurance companies have not explained to the customers well is, there is a portion of your premium which has gone to cover protection. I mean, it has a cost, and there is a corresponding benefit which has been passed on to the customer. Please factor that in. Now, if you exclude that and then you start calculating your returns, you will see a completely different set of numbers. Secondly, I mean, insurance contracts by definition, world over, there's nothing unique to about India, is the charges are fairly high upfront. So if you have remained invested for a short period of time, the chances are that you may not get as good as a return. But after a 10, 15-year long-term period, and that is why you should have invested in the insurance in the first place, you do get good returns along with the protection.
Okay. I'm going to come back to you, but first I want our viewers to understand the change that we're talking about. So Sandeep, if you could take us through the change in regulation and why you believe the new version of the ULIP is a far better product than it was earlier.
The first major changes happened in 2010, post-October 2010, where unit-linked products had a cap on allocation charge, admin charges, surrender charges. So the entire charging structure was completely changed. And obviously, all of this was in customer interest and makes the product better for the customer. In the recent regulatory changes that happened post-January 2014, we also have caps on the mortality charge that can be built into the product. So there's been significant changes in the overall charging structure, and under these specific heads like the fund allocation charge, admin charge, surrender charge, mortality charge. So the customer is significantly better off. In fact, unit-linked products for the right customer bought for the right reason today is a very, very compelling proposition for this very reason.
Sandeep, I'm going to apologize to you because the last time I asked you this question was 10 years ago, and I'm going to ask you again. Given the changes that we just talked about, why would I not just buy a term plan and combine it with a mutual fund? Would you say that this new version is actually more efficient than a term plan and a mutual fund combined?
I won't say general, but in certain cases, yes. First of all, I think the first product that you should buy is a term product. I don't think there is two opinions about it. Unfortunately, many customers do not buy a term product for whatever reasons. On the insurance, on the life insurance side, just before I answer that question, I will I'll supplement what Sandeep just mentioned. The lapse risk that was there in a policy, or the consequences of mis-selling that would happen in kind of a unit-linked policy has virtually gone away, for the simple reason that there is no lapsation risk on the customer. There is a small amount of surrender charges which happens, And even if you just pay one premium, the premium goes into something called a discontinued fund and you get a small nominal amount of interest. So at the end of 5 years, you will get your principal back. And principal means subject to whatever little market fluctuation that may happen. So you don't lose on account of lapsation. That's a unique feature of unit-linked products which has got introduced. I think it's a big, big win. Now your question of can I buy a term and can I buy a mutual fund? Probably the answer is yes. All right. Unfortunately, most of our retail investors don't have the discipline of staying on course. If you are very well disciplined and you want to buy a mutual fund with a SIP or a 10-year period and buy a term, great. But generally, what life insurance premium does, it is a SIP by design. I mean, you can get into a monthly mode and you start investing systematically. Secondly, you have an advantage of switching between debt to equity in case you have a different view. The third is more a psychological reason rather than a real reason, is because most people buy insurance as an investment to achieve a targeted goal. All right, I want a child's education or a child marriage which can happen 10, 15 years down the line. So I normally don't touch it. Come what may happen to my life otherwise. So to that extent, it meets that goal, it meets a need.
It's interesting that you talked about the fact that the discipline is normally necessary over a long period of time. And whether we like it or not, a lot of our viewers and investors consider mutual funds 3 or 4 year products. But the goals that are long term are pension, which is our retirement, and our children's education. Both of those products right now, child plans are not available because they're just not on the shelf at this point. And the retirement plans are woefully inefficient. So again, back to that same question, why would I use insurance policies then, or how can I use an insurance policy in both of these cases? Do you want to take, let's start with pension first.
Sure.
Why are pension plans from insurance companies so customer unfriendly and inefficient?
So insofar as pension plans are concerned, I think the key challenge is not what the companies would like to do. I mean, in fact, before the 2010 regulations change, at an industry level, pension plans delivered nearly 30% of the overall volume of business and value of business, new business that insurance companies were doing. So this was a significant component of our business, which literally went away when the regulatory changes happened. So why did that go away? It fundamentally went away because there were a couple of things that the new regulations mandated, which has made the products not so attractive for customers. And despite the fact that insurance companies have then subsequently introduced pension plans which are sort of compliant with the new regime, the offtake of these plans hasn't been good. So those reasons are very simple. One is that the pension products today sold on insurance pension plans do not give customers any option of partial withdrawal. Secondly, it's been made mandatory, and the regulator has had their reasons for doing that, but really doesn't work for the customer. It's been made mandatory that if I buy a pension product from company A, the accumulation part of it, I am compulsorily bound to buy the annuity part from company A as well. So as a customer, if I were a customer, I wouldn't be comfortable being locked in for a 30-40 year period with any particular company, because at the end of the accumulation phase, I'd like to review the annuity products of all the insurers and pick the one that suits me best or that gives me the best terms.
Considering I have to use an annuity.
Exactly. So I can't take a 40-year view as to whose annuity products or 20-year view as to whose annuity products will be the best 20 years on. While the purpose behind some of these regulatory changes could have been in customer interest, if you bring in features that are not attractive to customers per se, the segment got killed.
You nodded in agreement when I said people use mutual funds for only 3 years, but you disagreed when I said that pension plans are customer unfriendly. Do you believe in this current format it's still an efficient product that we should use for our retirements?
I'll tell you the advantage of ULIP, and then of course you can compare it. Now again, before you even start doing a pension kind of a product, because you also mentioned about child products, I would say is where are you taking your protection? I think fundamentally we have to get into, am I wanting to protect if something happens to me?
Yeah.
That is the first and foremost question you have to answer. Have I taken a term product? Unfortunately in this country, no, if you have, then you have all the options which are open.
Okay.
You have all the options which are open. I'm not saying this. Unfortunately in this country, people do not buy enough of term. So irrespective of what happens to the earning member, and I repeat, it's important to have the policy in the name of the earning member and not a child.
Sure.
All right? Because sometimes we make the mistake, we make the mistake that, okay, I've got 3-4 policies, ek is bacche ke naam pe, ek us bacche ke naam pe, ek biwi ke naam pe, ek mere naam pe. I mean, hold on. Who is the earning member here? So clear. I mean, if you, based on your family income and the person who is earning that amount, do you have enough cover? If you have that cover, then the choice is open to you. If you don't have that cover and people feel really, I mean, people do not like to buy term for whatever reasons, that is why they buy insurance when they try to club it. Because they say, mujhe kuch वापस मिल रहा है. Okay, if I survive, then I'm getting
So I'll tell
structure.
you this. This is what our viewers follow. This is what we've been telling them for the last 5 years. And you'll be surprised from the emails that we receive from the viewers on the show that they have health insurance, they have term insurance, they have critical illness insurance. Then they start investing. So
Correct.
assuming we're talking to someone who has checked all of these boxes, has an emergency fund of 3 months expenses in a bank account, so all of those eventualities have been looked
Then you should
after.
diversify the entire portfolio.
Okay,
You should
then
get
you
into
do.
something in peace.
That's-
You should be a
that's a
mutual fund. You should sell into a unit-linked fund.
Perfect customer.
Absolutely.
That's a perfect customer.
But
That's a perfect
unfortunately,
customer.
Faye, I mean, I can tell about industry, less than 2%, it's about 1.5% of our policies by premium is in pure term. So obviously, the kind of customers that you have talked about is very small. I wish it becomes bigger. It will be good for the customer, it will be good for the industry, and hopefully you will have lesser complaints.
All right, so this is the thing. Like we always say on this show, health insurance, life insurance, critical illness insurance, we'll talk about that in a little while as well. Then you start investing, and then you'll actually have the ability to just compare all of these products across the table and find out which one is the most efficient for you. We're going to ask some questions. Rabi Shankar Ghosh has written in, and we've shared this question with you earlier. He had bought the Life Stage RP plan from ICICI Prudential Life Insurance in 2008, he tells us. And he says he right now is really disappointed because he's been investing 30,000 rupees in this policy every year. The amount, he says, is lower than what he invested to begin with. He wants to know from you, should he hold on? Should he exit? What his options are?
I don't have the full details of the policy, so I'll probably give a generic response for what happened in 2008. Now, if you notice, it's a unit-linked plan, I suppose?
Yes.
It's a unit-linked plan. Now, unit-linked plans then and now were, you had a certain amount of money which went and covered as mortality cover, all right? So which has gone towards mortality. So when you're talking about comparing it, the amount's gone down, it is important for us to take out the mortality charges out of it and then compare the balance, all right? Over 2008, there has been periods where the returns have not been good. We have known for between 2008 till early this year, the stock markets have not been doing so well. But after that, they have been doing really well. And some of the returns that we have got...
Let's be honest. Any equity mutual fund right now with an SIP running from 2008 till date is well in the positive in terms of returns.
Sure.
All of them, in fact, even the worst performing one.
Exactly. Now, what I'm saying is, in this kind of a scenario, you would have had some kind of charges for mortality. But in this case, he has anyway spent... And anyway, most of the unit-linked products charges have been paid upfront. So it is important for him to continue to remain invested. Unless he needs some money immediately, then I would say, I mean, since the lock-in term is gone, he should surrender it. Otherwise, remain invested over a longer period of time, and then he'll get his returns.
Okay. So will you give me this guarantee that if we ask Rabi to get in touch with us again and send us his details, someone from your company
Absolutely.
will, break it all up into a pie chart that's easy to understand and explain to him where
If
his
he
money
gets
is
it to the company, he can write to us. You can give my email ID, sandeep.batra@iciccprulife.com.
All right, so that
I'm
email
more
ID,
than happy.
That email ID is on your screen right now, as is mine. You can reach us if you have problems with any of your insurance policies. Srinivasan has written in. He hasn't told us which company he bought this policy from, but he tells us he was missold a ULIP. He's diagnosed his own problem. He was missold a ULIP pension policy. He realized far too late, after paying a premium of 2 lakh rupees for several years, that his policy was just not efficient. He says it will mature in July 2016. He wants to know, does it make sense right now to surrender the policy, to take the money out, to continue holding it? Because he said he paid for 4 years before he realized that it wasn't really giving him the returns he wanted from this policy. And I'm taking this question sort of as an indicator of a lot of questions that we've received. So you tell us now, if like Srinivasan, if I'm holding a policy that I'm unhappy with, how long should I continue to hold it for?
Generically speaking, if he's bought a pension plan in the pre-2010 era, first and foremost, the plan would have a 5-year lock-in period at a minimum. Number two, again, to the point that my co-panelist made, a lot of the charges in this product would have been collected upfront. If it's a pension plan on a unit-linked platform, our general belief and advice to customers is that equity markets are doing well and are expected to do well over the next 3 to 5 year horizon. So most customers, if not all, would be better off staying invested in the policy. In any case, for the overall sort of unit-linked plans now, if you surrender before the lock-in period, it goes into a discontinued fund. After the lock-in period, you can withdraw the money. But and even in the discontinued fund, by the way, while the...
So give me these details, and I'm sure a lot of our viewers would be interested. I have to pay for 3 years in order for it to reach a paid-up value, and what happens after that?
Well, first, you should buy unit-linked if you're going to be invested in 10 years, all right?
Okay. Correct.
All right, get that fund up. First thing, all right, God forbid, for whatever reasons, you have a financial problem, and after paying your first premium and you realize you do not have the money, then the money after deduction of some small nominal amount of charges,
6,000 rupees,
6,000 is a cap,
Okay.
maximum. There's a percentage and there's a maximum cap. It moves something to a discontinued fund, which gets a return which is close to the savings bank interest rate, and you get the money at the end of 5 years, all right? But please, this is not a USP of this policy. This is to be used only in emergency. When you have got into unit-linked, it's for 2 reasons, long-term investments and protection.
Okay. All right, so you have to be interested in investing for at least 10 years. And this I'm going to hold you responsible for. All insurance policies have something called a 15-day free look period, which means you have 15 days to pick up a magnifying glass and read through that entire policy. And 15 days is a long time. And if you don't like anything about it, you can actually give it back and get all of your money back. And if you don't do that, then the rest of the responsibility is entirely yours. So you can write to us if you have more problems with your insurance policies. But remember, you went through that 15-day free look period and you did not read your policy document. Welcome back. You're watching Investor's Guide in ET Now. This is our insurance special. Remember, we promised you that we bring in experts from the industry to answer your questions. Sandeep Batra from ICICI Prudential Life and Sandeep Ghosh of Bharti AXA Life are both in the studio with me. Gentlemen, I want to ask you about term plans. We get a lot of questions from our viewers asking us, why are they so cheap? Why is there such a massive difference between what the private industry is charging us and what LIC charges us for exactly the same cover? Is there a catch here somewhere? Take us through why term, especially online, is so competitive, and if there are any risks at all from buying online.
Absolutely no risks from buying an insurance product online. The term product that is sold online is cheaper for 2 reasons. One, distribution cost being eliminated to a large extent, as well as the fact that the actual quality of life and the actual self-declarations that customers make is of a higher standard, which influences the pricing of these plans.
Yeah, absolutely. I just want to add what Sandeep has mentioned is your first policy has to be a term. Online, offline is a secondary matter. I mean, that's important to be a term policy and ensure that it is of sufficient amount to cover the risks. Secondly, I mean, when you are disclosing your illness, please do not hide anything.
Hide anything.
Correct.
All right, that is very, very important. Sometimes the tendency for us, especially in online, is to tick, everything is fine with me. Please do not do this. If there is an issue, please disclose. It's
especially issues like smoking and things like that.
Smoking, or if you have had a heart problem, etc. It's not that the insurance company is going to decline your policy. They could be an extra rating, or insurance company could still decide to take on the risks with a little higher charge. So it's very, very important, both online and offline. I mean, the first thing that we learn in insurance, it's a matter of utmost trust between the insurer and the insured. So please give complete and truthful
declaration. I think at the time of the claim, if you discover that I lied on my policy, you have the legal ability to deny me
That's
the claim.
the problem.
Yes.
That
Irrespective of online or offline.
And you may not be there.
Yeah.
And you may not be there to defend at that point of time. So that's important. The other things where offline also comes into place is because most companies have sort of a cap on the sum assured that they will do online. So if you want a real larger sum assured, you would mandatorily have to go to offline. I'm not saying online is bad or anything. I'm just telling you areas where offline also comes into place. And secondly, when you are going a medical, I mean, sometimes at high sum assured, most companies will ask you for some kind of a medical. I mean, the obligation on the insurance company of having examined the life assured increases. So the chances of any non-disclosures, so to say, reduces significantly.
Okay, I want to ask you this. Fortunately, I'm sitting among people who have the nicest claim ratio among the private industry. But how important is the claim settlement ratio when I'm deciding? Because technically it's a service, the term plan, to choose between different companies. I shouldn't just go by which is the cheapest. How important is the claim settlement ratio?
First and foremost, if you've done all the declarations right and you've bought the product the right way, there is no chance of repudiation. Repudiation is only something that can happen when there is something that has not been divulged, declared. There is some kind of reason. I cannot legally repudiate a claim unless I have a very, very good, strong reason to do that. And this is something we companies take very seriously. So what is the settlement ratio of a regular claim versus what we call a non-early claim, which means the policy has been in force for more than 2 years, versus a early claim? Now, if I'm getting a claim on a policy that wasn't even in force for 2 years, it is my duty as a company to investigate that and be very careful before I pay that out. But if the policy has been in force for 2, 3, 4, 5 years, let me assure you, 99.9% of the times the claim will be paid. Okay?
All right.
Absolutely.
We're running out of time, but I want to now talk about child plans, because we've got phone calls from people saying, I went to buy a child plan and apparently they are no longer available.
No such thing.
Why child plans are no longer available?
No,
Not true.
I know why people. Okay, why do you buy a child plan in the first place? I mean, why do? Are we saying that the child is going to be the life assured, or are we saying the child is going to be a nominee? I don't think so. Most parents would be as perverse to have the life assured as a child.
A child plan is where something happens to me and then the rest of the premiums are being waived off and things like that.
But that is true for any plan, no? Okay. I mean, you need a policy, again, I think I said it earlier, on the person who is earning. A child doesn't earn. So you don't need a policy where the life assured is the child. Okay, unless it's a pure investment and you want to do it.
ICICI Prudential Life, they spent the last decade telling us to buy child plans. Are you now telling me that?
No, in our child plan, hold on. In our child plan, we made it mandatory that the life assured was the parent.
Fair enough, but are those plans available in the market?
They have been discontinued because we have not been able, because under the new regulations we have yet to file in the new format.
Okay, so it's all temporary.
It's all temporary.
In terms of plans around.
No, but let me get this.
Let him finish. Let him finish first. It's an emotive subject.
No, it's important. I mean, if I have bought a term plan for myself, all right, and if something happens to me and my family gets the money, that's a child plan.
Okay.
Right? As I've got any policy where the earning member is covered and the beneficiaries are the children, that's a child plan. Okay. Now, if you want to brand something as child plan, that is something I think some companies are taking more time than others, because in terms of prioritization of filing the IRD and approvals coming, etc. But the product does exist.
Every insurance plan, if sold the correct way, with the right kind of riders attached to it, can basically function as a child plan. So rest assured, there is no. So the discussion on pension, for example, is very different from child plans. Yeah.
All right, so this is interesting. If you have a term plan and it's a good, solid term plan with a large cover, then your child is already taken care of. And after that, like we said, once you get all of those things done, compare it across the table. If you want to buy it in your child's name, you want to buy it in your own name, any investment with the mental discipline that this money is for my child's future is a child plan. So you don't have to go after that branding. Let's answer a few more questions. We have one, and this one is very generic. Raj has written in, he pays a premium of 5 lakh rupees. He says, he wants to know, if he pays a premium of 5 lakh rupees as a single premium and holds the policy for 10 years, will there be tax on that maturity amount?
Very straightforward answer on this one. As per section 1010D, it's not the premium that he pays and what the maturity amount is, but what is the life cover. So if the life cover is 10 times, which means that for a 5 lakh premium, is he getting a 50 lakh cover? So if the product feature gives him a 10-time cover, then the maturity amount is tax-free at maturity. Sandeep, I hope you agree, and I have not said anything.
No, the question I have for Sandeep is far more difficult. Ajay has written in, Karan has written in, he invested in the ICICI Prudential Lifetime Super Pension Plan in 2007. He paid 84,000 rupees. He tells us now if he discontinues the policy at this point, he'll get 1.1 lakh rupees. He says the policy will expire after 23 years, where he will receive a regular pension. He wants to know, should he hold on to this policy if ICICI Prudential Life will allow him to convert the policy to an auto transfer scheme?
No, no, the auto transfer scheme is a little different. I mean, where is the choice of moving? It's available in most of our products, in most of our unit-linked products, where you can move something from a debt fund to an equity fund. So that is something which is different. I don't know which kind of fund has he invested in, but generically, I would advise every customer that unless he needs the money right now, let him continue, let the policy run its own course. So that's a general. But if it's a specific case of his, we can have it looked at separately, and he can certainly contact us.
Both Sandeep and Sandeep will answer more questions if you have for them, whether it's for the specific insurance company or it's in general. Write to us. Email ID is on your screen. Any insurance policy you're having trouble with, understanding it, or with the investment altogether, we're here to help you. Gentlemen, thank you so much for spending time with us and answering all of those questions.
Thank you.
That's a wrap on Investor's Guide. If you want this video, it's on our Facebook page. You can reach me on Twitter. It'll be my pleasure to hear from you. Thanks for watching.